Hi, it's Nishi, and in today's video what I want to talk about is the 3 ways in general that you can actually save money when it comes to tax. And there's loads of allowances, loads of things you can do out there, but they generally fall into these 3 areas, and I just wanted to make you aware of them because they're not all equal, and there's areas you should really focus on and areas where you might not need to really focus on as much. So the first one, and this is by far the most important way people actually save tax, it's just about structuring the way they withdraw income from their limited companies. What do I mean by that? Well, quite often they've got family members involved, quite often they've got various other forms of income, or they've got various allowances, the personal allowance, the basic rate band, the high rate tax band. Like managing the way income is taken out of the business, not just for yourself in terms of what you leave in, what you take out, but what certain family members that are involved in the business leave in and take out as well. And using holding companies effectively is by far the biggest and most effective way to actually save money on your tax bill. The second one is still important, and that is by claiming all of the reliefs and expenses and allowances that you are entitled to. So like allowances could be something like working from home, or your mileage if you don't have a company car, or the expenses could be about putting a company car through the business. It could be about expensing certain things like trivial benefits, your Christmas party allowance. By using all of that effectively, there is still tax savings to be had, just not as much as the first way, which was about structuring your business right. And don't forget that second method also includes things like research and development tax credits, annual investment allowance, all those government incentives that are there to help you invest and grow the economy. And then the third one, it's not as important, but it can still be relevant, especially if you're early on in your business or you're investing in growth, because it's about utilizing timing differences to push a tax bill back or forward into various tax years. This could be around when you specifically take dividends and which tax years you take them. It could be around when you make particular purchases to try and bring a tax savings forward. Whilst in the long run with method 3 and exploiting those time differences, you are still paying the same amount of tax. In reality, being able to push that tax bill back a year can often be really useful when you need the cash flow to be able to grow. So those are 3 main ways to do it: structuring your income right, making the most of expenses and reliefs, and making the most of timing differences. So if you want to find out a bit more about this, then definitely get in touch, because I know for a fact that most accountants miss the first one and get their clients to leave a lot of money on the table. So if you want to talk about that, I'd like to talk about that, and I'll see you in the next video.